Good morning, everyone. Thank you so much for joining us today. I'm Anne, and I'm going to be taking you all through our latest update on what we're seeing happening in the economy, particularly how it's affecting what we're seeing in the commercial property market. So to kick things off, if we look at what's been happening in Australia's economy over the past year, video, there we go. Can you still see my screen? Yep, great. So if you see what's been happening over the past year, we've really seen economic growth slow to a standstill in Australia. Our economy grew by just 0.1% over the March quarter. Now, really the only reason we're growing at all is the fact that we have seen extremely strong population growth over the past 2 years. Because if we look at what's happened to our economy on a per capita or per person basis, Australia's economy has actually shrunk over the past 4 quarters, for a year now, relative to the number of people in the country. Now, the last time we saw this level of persistent negative per capita economic growth was actually at around the 1990s during that recession period. So what we're seeing at the moment is actually particularly concerning, and really it's just that population growth that is keeping us above board. So this is what population growth looks like. So our country has been growing by about 1,800 people a day. We grew by over 650,000 people just in 1 year last year. Now, this is a record. Australia has never experienced such a strong rise in the number of people living here in our history. And if you look at that chart on the right, you can see that it's predominantly that net overseas migration which is driving the rise. So things like skilled migrants, international students, those are the people that are actually keeping our economy growing at the moment. Despite the fact that we have seen economic growth slow, despite the fact that we have more people living here now, the unemployment rate remains incredibly low by historic standards. But you can see that over the past year, we have seen the unemployment rate start to pick up. It is starting to trend upwards. Now, I have a couple of theories as to why it's still so low. The first being that during the pandemic years, we had a significant shortage of labour. And I think that businesses are still recovering from that. And I think that the mindset is still very much to hold on to the workforce that you've got to avoid that situation that we saw during the COVID years. Another reason is that unemployment is actually a very lagged variable. So when a company decides that it's going to have redundancies, between them making that decision and the redundancies happening and those people entering into unemployment statistics, there's about a 4 to 6 month lag. Also, we are likely to see the unemployment rate rise further. SEEK in their latest data show that in May, there are about 18% fewer job ads online compared to the same month last year. So this decrease in job ads is very likely to translate to an increase in the unemployment rate from where we're seeing it right now. Okay. So what are we seeing in the commercial property market at the moment? Well, for about 2 years now, we've seen a very significant slowdown in transactions. And the key driver of this has been that sharp rise in interest rates we saw from mid-2022 onwards. Now, what we saw was that even though the cost of capital increased very dramatically, commercial property values didn't adjust in line with that. The adjustment has been very, very slow and gradual. And what this has meant is that there's been a really big discrepancy in what the prices that vendors are willing to accept versus what buyers are willing to pay. Encouragingly, though, we are starting to see that gap decline, which hopefully is going to translate into more sales, hopefully over the second half of this year and certainly into next year. And I have some more data from our site that supports that theory. In terms of the commercial property types that are selling, well, we've actually seen a decline in the sales values across pretty much every asset type. but really offices have seen the sharpest decline since that time that interest rates started going up. And then, of course, after those COVID years, where people were questioning whether there was a place for offices in the future. Interestingly, if we think about offshore investment into commercial property in Australia, offices used to be the asset class of choice with those investors. That has now really shifted. Yes, we are still seeing demand for office from offshore, but industrial has taken up a lot of that demand. I mentioned that we are probably going to see an increase in deals being done over the second half of the year. And the reason I say that is that we've actually seen a pretty significant jump in the total number of properties being listed for sale on our website. And you can see that across every asset type, except for the hotel leisure sector, we've seen not just an increase over this financial year versus last, but an even stronger rise in listings if we look at May of this year versus May of last year. So the majority of that increase in listings is from the past few months. Also encouragingly, we're not just seeing more properties being listed, we're also seeing inquiries pick up. So across the board, we've seen a bit of an increase in the number of people who are inquiring to buy and also to lease properties on realcommercial.com.au. Okay, so as I mentioned, to summarise why I think we are likely to see investment volumes increase over the second half of the year and into next year is that price expectations gap has been narrowing. What we've seen is that yields, they were very slow to react to interest rates at the start in 2022, early 2023, but that yield expansion has been slowly growing. And now it looks like we're actually starting to slow. So what that means is that we look like we're close to that yield expansion cycle being done. There's probably some more space to go, particularly if we do see another interest rate rise this year. But we're very close. And I think what that means is that those investors who have been waiting for values to readjust in line with interest rates may now be starting to re-emerge. Also, the fact that we are seeing more properties being listed for sale is a really positive sign that vendors do want to get deals done. And then, of course, there's that more concerning aspect, which is that we have seen an increase in distressed sales. And with economic conditions quite weak at the moment, there's a very strong possibility we will see distressed sales rise further. So shifting to the industrial sector specifically, I mentioned that the industrial sector has been a real outperformer over the past 5 to 10 years. And interestingly, what we saw happen was that when industrial property became hot property, we saw a lot of private investors being priced out as larger institutional investors came in. Post interest rates rising and the price points not being really where they need to be, we saw those larger investors decrease, and that created an opportunity for smaller private investors. So privates have been accounting for a much larger share of industrial property sales over the past 2 years compared to where they were in the previous 5 years. Once we start to see industrial yields fully reach that point where that expectations gap between what buyers and sellers are willing to accept, we are likely to see more larger scale investors come back into industrial because it is a sector that is going to continue to perform well over the next few years. If we look at where vacancy rates are sitting, we have seen things cool in the industrial sector, but things have cooled off what was record low vacancy. So we saw demand for industrial property absolutely surge during the pandemic years. E-commerce in particular during lockdowns drove that demand for more warehouse space. We are now seeing those vacancy rates increase. I'll talk about it a little later, but there's actually a lot of industry sectors that are seeing businesses more likely to fail. We've seen insolvencies rise, and this is contributing to the higher vacancy rates we're seeing. But these vacancy rates are still incredibly low by historic standards. We think of an equilibrium vacancy rate as being about 3 to 7%. So the fact that we're seeing less than half of that level across Australia is still a really positive sign for the industrial sector. So in terms of the proportion that people are spending online of retail sales, you can see that it was trending upwards pre-COVID, then it absolutely surged and reset that trend line during the pandemic. But one interesting thing I've noted is that if you look at food sales online, they have grown at a much more rapid pace than non-food sales online. So they had been tracking at the same rate for quite a long period, but post-COVID, we've actually seen significantly more growth in that online food sales category. Now, this is percentage. So of all retail spend, how much is being spent online? This next chart shows that dollar value. As I mentioned earlier, population growth really is that key story in the Australian economy at the moment. And even though people may be individually spending less, there are more people here spending. And so the dollar value being spent online is continuing to rise very significantly. So what does this mean? It means that warehouse space is going to be in demand and the e-commerce sector is going to remain a significant driver of this. So when people search to buy industrial property on Real Commercial, they can include keywords. And I love tracking these keywords because they paint the picture of those changing trends that we're seeing in the market. Now, 5 years ago, storage was not even in the top 20 most searched keywords on Real Commercial. It's been slowly rising up the ranks, and over the past year and a half, it's been sitting at the #1 spot. You can see references to freezer, cool room, cold storage, food. Those have all also made the top 14 most searched keywords. Again, I think we're going to see a real opportunity, a very strong demand for cold storage space, really off the back of things like that increase in demand for online food retailing, also pharmaceuticals, for example, that need temperature-controlled spaces. Okay, so the retail sector is one that has been doing it really tough. And to sort of paint the picture of what's going on in the retail sector, I think it's good to dive a bit deeper into the economics of the household budget. So over the past 4 years, wage growth has been 12%, but inflation's been 18%. So on average, Australians have taken a cut in their real wage. And if you look at the items that have seen the biggest increases in costs, they are the things that people have no choice but to spend money on. So transport, housing, food, insurance, education, all of those things have gone up, and that's leaving people with less in their hip pockets. Concerningly, when we saw the latest inflation monthly indicator for May, it actually showed that inflation picked up. Now, the monthly indicator is just an indicator. We may actually see the official inflation rate a bit lower, but if this indicator is accurate, that means that there's a much higher chance of another interest rate rise this year than we would have thought 3-6 months ago. So with people spending more of their wages on basic necessities, this has really hit Australians' hip pockets. So if we look at the pandemic years, the average amount that households were saving increased dramatically. That gave us all a buffer so that when interest rates did start rising, when inflation picked up, we had this reservoir of savings that sustained us for a while. We've now reached the other side of that. And actually, the average household is now saving less than 1% of their income. So this is a big concern, and it is going to hit the retail sector. It already is. And of course, it's going to have other implications for our economy as well. If you look at retail turnover on a per capita or per person basis, as I mentioned, you can see how it's hitting the market. So since the sort of mid-2022, the average amount that people are spending on retail has been steadily declining. Now, it is still sitting above those pre-COVID levels, but that has a lot to do with inflation and the cost of goods being higher now than they were then. But even though people are individually spending less, as I mentioned, there are more people spending. So if you look at total retail turnover in the Australian economy, you can see that it's really held steady for about 2 years now, it isn't growing, it's holding steady, and that's really that increased population that's sustaining retail turnover. In terms of the assets that are transacting, we have seen some big declines. If we look at the count of retail sales, centres have seen the sharpest drop. Again, this comes back to institutional larger investors being more absent in the market than they were relative to private investors. So we are still seeing more, private investors out there looking for properties to buy. So that's driving transactions of shops. But yes, those larger retail assets have seen a very substantial slowdown. Okay, so shifting to the office market, we have seen the vacancy rate continue to rise. I think the Property Council will be releasing their latest vacancy data in about a month. So that's going to be really interesting to see. Now, it's unfortunate that the Australian office sector actually saw an absolute surge in new office supply delivered between 2020 to 2022, which of course coincided with a lot of companies contracting their space requirements off the back of the increase in remote and hybrid working. Now, if we look around Australia, there's a few markets that have been hit particularly bad. So Melbourne has been hit harder than any other market. That's understandable. 16.4% vacancy as of January this year. In January 2020, that was sitting at just 3.2%. So Melbourne has seen a nearly five-fold increase in its vacancy rate. Sydney is another market that's been really hard hit. So that 12% vacancy rate is up from 3.9% as of 2020. Interestingly, though, apart from those two markets and Adelaide as well, a lot of the other states have actually seen the office vacancy rate decrease. Perth is a good example of that, where the vacancy rate was actually sitting at about 17.5% in 2020. So it's actually decreased quite significantly. It's also lower now in Brisbane. So these are markets where they didn't spend as much time in lockdown. Perth has had an outperforming economy over the past year, and that's supporting that demand for office space. Another really positive sign for the office sector is that we have steadily been seeing occupancy rates increase. So you can see that this year the office occupancy rates are higher in every market. And wonderfully for Melbourne, we've actually seen that office occupancy rate finally go above that 50%. Those purple dots are peak day office occupancy. So you can see now in markets like Adelaide, Perth, Brisbane, they're sitting at around that 90% or above, which is really encouraging. Melbourne still has a long way to go, but that trend of occupancy is moving upwards. Another interesting trend is that for those businesses that are considering a green building, they have pretty high expectations. So when companies are searching for a space that has a NABERS rating, they are more likely to favour a minimum 4-star or minimum 5-star rated building. So this really picked up, you can see that shift back in 2020, 2021. There are a lot more businesses willing to consider lower star ratings. That's now really shifted, and over the past few years, we're consistently seeing more businesses favouring those higher star rating buildings. Okay, so for those businesses that are searching to lease office space on Real Commercial, I've tracked the keywords, and 9B, education, are really high up there. Those are two, education is an industry that is driving demand for office space. It has for a long time now, and that's going to help to support take up. But you can see a lot of these keywords that come up relate to amenity and things like character. And, even though we are seeing more people come back to the office, I think that we're not just going to go back to the way we were pre-COVID. The purpose of the office has shifted in a world where people can do their jobs from home. So for businesses to get the most out of the office space that they're paying for, it really needs to offer a lot. I just wanted to also add a couple of slides looking at those industries that are driving growth. We know that the sectors where employment's increasing the most rapidly, they need space for their workers, which means demand for commercial real estate. Now, the healthcare sector really is the sector that's predicted to add the most jobs to our economy. And you can see that that education and training sector is in third spot after there. So those are two sectors that are going to be supporting demand for real estate. And if we look at the speed of our population and our ageing population, they're two sectors where we're probably seeing a bit of an undersupply of property at the moment. I mentioned we're ageing, and this chart basically shows how the breakdown of Australia by age category is going to shift over the next 50 years. So at the moment, we have more 0 to 18-year-olds, more children, but you can see that by about the mid-2030s, in about 10 years' time, there will be more people aged over 65 than under 18. Now, even though we are going to see a growing share of older people, every age category is going to see a rise in their numbers, and this will support demand. So even though people are having fewer children, there are still going to be more children overall because of that growing population, which will support demand for things like childcare, education, schools, community colleges, those sorts of things. Then, of course, that 65 plus category is going to mean a significant increase in demand for health services. So in terms of spending on things like healthcare, that actually increases 20-fold because the 65 plus category compared to the 0 to 18 category. Okay, so challenges. The biggest challenge at the moment for commercial property owners is that there is a significantly heightened vacancy risk compared to a few years ago. Now, in May of this year, we saw more businesses enter into insolvency in Australia than we've ever seen in a single month in history. So this is very concerning. We saw insolvencies fall to record low levels during the pandemic because of government supports. In the absence of those supports, we've steadily seen insolvencies rise. And instead of returning to sort of a normal historical level, they've continued to rise, and they're now sitting at those peak levels that you see there. Not only that, but the survival rate of businesses is down across every industry sector. So I've ranked these sectors based on the industries that have seen the biggest drop. And I'll just explain a few of these sectors and the specific kinds of businesses that are most at risk. So if we look at the transport, postal, warehousing, the industries there that are most likely to fail are in the road transport sector. In public administration and safety, it's security companies that are going bust the most rapidly. In administration and support, it's employment services. And that's also quite concerning because when we start to see businesses operating in employment failing, that's again a signal that unemployment is likely to rise. Businesses aren't hiring as rapidly as they were in the past. So that's actually quite a concerning one. Accommodation and food is predominantly cafes and restaurants. And if we look at construction, which actually has seen more insolvencies than any other sector, insolvencies are being driven by the residential construction sector and related industries. Another interesting one is with manufacturing. The majority of manufacturing businesses that are entering insolvency are exposed to that residential sector. So they're building input manufacturers, so timber, metals, that sort of thing. Now, I talked about the residential construction sector, but this is also the non-residential construction cost index. And you can see that the cost of building right now is at a record high. The speed at which construction costs rose was incredibly dramatic, far above what we've seen in the past. Now, this is a challenge, but I think it also is an opportunity for existing owners of commercial property. Yes, the market hasn't performed so well at the moment. There's a lot of challenges in the economy at the moment. Vacancy risk is up there, but the fact that building costs have risen so much so quickly has had the effect of actually slowing down the future pipeline of of properties that are going to be delivered. And we're actually seeing this across the suite of sectors. So if we look at the retail sector, you can see that all retail property types have seen a decrease in that future supply of properties being developed. Now, this is actually a good thing, I think, because even though we are seeing more insolvencies, people are spending less, because our economy is growing, our population is growing, and there are more people spending, a slowdown in the speed of new development is going to support the performance of existing properties. Similarly, we've seen a slowdown in the number of new office buildings being built, and a lot of these buildings that actually have approval to go ahead, a lot of them are being deferred at the moment as well until conditions are more favourable or they have very high pre-commitment rates. And going back again to that population growth story, which I think to anyone trying to sell the Australian market to an offshore investor, we are growing at the speed of a developing country. The population growth that we are expected to see over the next 5 years, which, by the way, is forecast to be less than what we've seen over the previous year, is so far and away above what we're seeing in other similar markets around the country. So if you look at the OECD total average of just 2.1% population growth, we are significantly above that. Now, that population growth is going to be felt across Australia. Victoria is the state that is going to see the most, followed by New South Wales. Finally, I just wanted to talk about which businesses are likely to grow. And even though we did see record numbers of businesses entering insolvency, it's important to remember that even though there are businesses that wind up, there are always businesses that start up. And overall, we've actually been seeing more new businesses starting than ending, which is really, really encouraging. And you can see that healthcare and social assistance sector has seen the most new businesses. And again, that's predicted to stay in that #1 position over the next decade at least, as a result of our ageing population. So that is the end of the slides. And I think I am a little early, so there might be some time for some questions. No? All right. Well, thank you so much, everyone, for joining us today. I hope you got something out of today's presentation. And yeah, I guess I'll be here this time next year.